Okay, I'll be doing this video for corporate finance. I'll go over some of the most important aspects of the most important points to consider in capital budgeting. Okay, so a firm is wondering whether or not to undertake a new project. So the value of the firm usually, like the value of a firm corresponds to the present value of all its future free cash flows. We have seen earlier that free cash flow is earnings before interest and taxes times 1 minus the tax rate, which we will refer to as the unlevered net income here. Plus we add back depreciation. Depreciation has been subtracted within EBIT. We add it back because it's a non-cash expense. We subtract additions to net working capital, and we subtract the investment in fixed assets. In this chapter, the investment in fixed assets will be represented by capital expenditures, CapEx. So capital budgeting refers to the analysis of the value created when allocating some capital into a new project. When deciding whether or not to undertake a new project, the firm must consider the impact of this project in the form of delta free FCF, so the additions to the free cash flow. So this is the additions to earnings before interest and taxes plus the difference in depreciation plus additions to net working capital plus capital expenditures. So the new project will generate new sales, but it could also decrease or increase the sales of existing products. So launching a new product may cannibalize existing products. Okay, so you are a toy company, you produce a new type of toy. Well, like parents making gifts to their children on Christmas, they may choose your new toy instead of the old one. You're a beer maker, you produce a new type of beer. Well, your customers may buy the new type instead of the old one. But cannibalization is not an issue if not launching the new product will make you lose these sales anyway. So your customers who would be switching from your own old product to the new product will switch to the new product produced by your competitor if you're not the one doing it. Okay, so if you are a beer maker and you want to produce a new type of beer, which is a mix of beer and gin, for example, and you don't do it because you're afraid that this will reduce the sales of your existing brands. Well, if you have a competitor who takes like a similar recipe and does it and attracts like a portion of your customers that would have liked this type of beer, well, your switching customers are switching to another firm. So you prefer that your customers switch within your own products than your customers switch towards your competitors' products. At the same time, launching a new product may be accompanied by an advertising campaign that may attract new customers to your existing product. So your overall sales could even increase. Tax considerations are important, but the real tax considerations. Okay, so taxes paid on the operating income produced by the new product are the actual taxes paid to the government. Okay, and the tax rate is the tax rate. That is determined by the government. So within these calculations, the depreciation formula that has to be used is the one that is consistent with the depreciation formula used when reporting your income to the government. Okay, so corporate entities, businesses, firms may report different income to their shareholders than to the government. So when reporting income to shareholders, so companies will apply a tax rate and a depreciation rate, which is consistent to what you need to know now, okay, to understand what the firm can do over the long run. So this is what you report to shareholders. What you report to the Canada Revenue Agency is, your actual income that you obtain when you apply the depreciation rate that the Canada Revenue Agency obliges you to use, the tax rate they forces you to use, okay, and this is how you pay taxes to the government. But the CCA rate, so the depreciation rate that is used when reporting revenue to the government is called capital cost allowance. So the CCA rate may not be the right depreciation to use when reporting income to shareholders because it does not necessarily represent like the true, accomplishments the firm can do, okay, with its sales, costs, and so on. So a firm may have may report like different values to shareholders and to the government, but in this specific scenario here, so capital budgeting here is done within the firm, for the firm, and so that the CEO of the firm can tell whether or not this project will bring cash or if it's going to burn cash. As before, more sales imply more inventories, more accounts payable, more accounts receivables, and so on. So that means additions to net working capital. So additions to net working capital are a short-term capital expense. And additions to long-term assets are going to be the assets that will have to be purchased to undertake the project. And if the project is temporary, so if we plan on producing a specific type of beer for 5 years or a new toy, okay, just so that it lasts. So there's a movie that's super popular lately. We want to produce a toy associated with the movie, but we know that 5 years from now, people will have forgotten about that movie. So we plan a project that will last 5 years. We buy assets today, produce the toys, eventually sell the assets 5 years from now. Okay, so within the capital expenditures, there we have to include the sale of the assets when we dismantle the project. Okay, now capital budgeting, the most complex part of this chapter is CCA depreciation, which we will cover in the next video.